Welcome to the Norris Group Real Estate Podcast, a show committed to bringing you insights from thought leaders shaping the real estate industry. In each episode, we'll dive into conversations with industry experts and local insiders, all aimed at helping you thrive in an ever-changing real estate market, continuing the legacy that Bruce Norris created, sharing valuable knowledge, and empowering you on your real estate journey. Whether you're a seasoned pro or a newcomer, this is your go-to source for insider tips, market trends, and success strategies. Here's your host, Craig Evans.
Hey, thank you for joining us again for part 2 of our interview with Bill Exeter of Exeter 1031 Exchange Services, LLC. Let's get to it. Okay, so let's get into what's a reverse exchange and what's the biggest difference between this and the forward exchange?
Good question. Maybe I'll start off with the risk of a forward exchange. With a forward exchange, you are selling first, you trigger your gain. And as long as you can identify within the 45 days and then actually acquire the property, you defer it. So it's not taxable. But if something happens and you can't identify or you can't acquire the property, then the forward exchange becomes a taxable sale. And there's no way to go back and fix that. So that's really the risk on a forward exchange. But the forward exchanges are much simpler, much more straightforward, et cetera. With a reverse exchange, it allows you to go out and spend all the time you want to find the new property. You buy the property, so you go into contract. You can actually close on the purchase of your new property first. Then you've got the 180 days to sell your current property. Sounds easy, but they're a lot more complicated. There's more costs involved. So, one way to explain it is a pure reverse exchange, which does not exist, but a pure reverse exchange would mean that the client could go out, buy the new property, take title to it, own both properties at the same time, and then sell their current property within 6 months. And the IRS doesn't permit that. So they've set up what they call a parking arrangement. So in most cases, the new property you're going to buy, we have to acquire and hold, or what the IRS calls park legal title to the property. So the only thing that occurs up front in that structure is we park title to the property. The 1031 exchange hasn't even entered the picture yet. And then let's say a few months down the road, you sell your current asset. And at that point, it's really a concurrent exchange. You sell, you close on the sale, you convey title to the buyer of your property, and then we transfer the property to you that we've been holding on your behalf. So it's really kind of a back end or exchange last, as they call it, where we swap the properties at the back end. So it takes a lot of the risk out of the market because you've closed on your new property first. It's just more complicated. Traditional lenders don't like the fact that we're holding title to the property. So if you could do an all-cash purchase, it would work great. If there's a lender involved, we have to kind of go through the process to see if the lender will allow it.
Now, is there a risk of accidentally triggering a reverse exchange?
Good question. I guess the only risk is we've had people who haven't talked to anyone about the reverse exchange. They maybe read up on it in the internet and they don't realize that they have to do this parking arrangement. So we'll get phone calls all the time where they say, well, I bought the property. Now I want to do a reverse exchange. And if they got title to the property, it's too late to do the reverse. So I guess they didn't really accidentally.
So either way, you still have to plan it.
You have to plan it. Everything has to be set in place before closing. It wouldn't be accidentally triggered, but they could accidentally buy it, not realizing they have to park it with us. So that's really the risk that we see quite a bit.
Okay, and then the third one that we're really familiar with, especially here at the Norris Group with our boot camp, is the improvement exchange or the build exchange. And is that the most complicated of all the processes?
Definitely most complicated of all the processes. And the improvement exchange can be done either with a forward exchange structure, which I think most of them are done that way, but it could also be done with a reverse 1031 exchange structure. I'll use the forward because that's what most people do. So you're selling your current property first. The funds come to us at closing. Then you identify the property that you want to buy and build on. So you're really identifying, in most cases, dirt. And then you're identifying also what you intend to complete or build out on the property. And then it's just like a reverse structure. We take title to the property you want to build on. So it's the same parking arrangement. And then they have the rest of the 180-day period to actually complete the capital improvements. And the neat thing about the Florida boot camps with you guys is, of course, everything's kind of lined up in advance. So really you sell, usually day one, you're already starting the construction and build out. So you've got the full 180 days. A lot of folks who are doing it on their own, they close, we're holding the cash, and they identify right around the 45th day. So they've already lost a month and a half. And to get permits in another, 4.5 months is almost impossible.
Yeah. So you just said something that a build exchange could be done in a reverse exchange. So when does that start, the 180 days? Like, because, when you're buying something that's already existing, okay, that's when you bought it, Now, the build cycle, if you look at the last 3 years, that has fluctuated from 5 months to 18 months, some people even 2 years to complete a build. So how does that work?
Yeah, good question. It's just like a reverse exchange. So we would set up the reverse. They would go under contract, etc. We would be assigned into the contract. So we step into these shoes as the buyer. When the closing occurs, we actually take legal title to the property or park title to it, just like the regular reverse. Then the only difference is once we take title, that's when the 180-day period starts. So at that point, they could start doing the build out right away. And the sale of their current property may be 4 or 5 months down the road. And as long as we can wrap all that up within that 6-month period, then it would certainly qualify. The beauty, again, is you buy first. So you take the risk out of, whether or not you can find replacement property. There's just more complexities to it. And if there's a traditional lender involved, they probably won't touch it. Now, construction financing, they usually will take a look at it. So it's certainly a possibility.
Now, do all the same deadlines apply? 145?
Typically, yes. If you want to do a safe harbor, which means you're following the revenue ruling that the IRS came out with, or revenue procedure, then you would have the same 45 days, in this case, 45 days to identify what you're going to sell because you've already bought. And then you've got 180 days to do all the purchase and then all the build out. There's one case where they structured this as a 24-month process, and they finished it in 17 months. The IRS disallowed the transaction. It's the Bartell versus Commissioner case. They took it to court, and they won. So we have a case on the books now that says you can do that. However, the IRS has also come out and said, yep, we still hate it. So if you do it and you get audited, you're probably going to be doing battle.
So in that case, if you did it knowing there's precedent, there's a chance they could still disqualify, but then you'd probably have to go to court to try to get it.
That's exactly right. And if it's exactly the same fact pattern, you might get lucky and prevail. If it's, everybody's case or transaction is always a little different. So you just never know. It's certainly not for the faint of heart.
Now, one of the things that happens in these build exchanges is you create exchange LLCs. Can you tell us a little bit about that?
Yes. So with the improvements, and also the reverses with that parking arrangement, there's a number of ways of doing it. One way, which we do not recommend, but one way is the exchange company may have one entity, like a C corporation, and they'll use that entity to acquire and hold all client properties. Well, that could be a lot of properties in the same year. And if any of those properties have any kind of an issue, liens, judgments, toxic waste issue, whatever it might be, it could affect the entity and it could affect all the properties in the entity. So we always set up a brand new LLC for every single client. We never reuse the LLC. And that way the LLC is acquiring and holding legal title to the property. It's a brand new LLC, so the client doesn't have to worry about any other client or any other real estate. It protects the client from liability. It also protects us from liability. So that entity is owned by us during that 180-day window. And then with improvement exchanges, it's almost always on the 180th day we transfer that LLC to the client. They become the owner, signer, etc., and that's how they get ownership of the property.
Now, what if, let's say I end up like, this is going great. I want to do another exchange. Can I use the same LLC to do a back-to-back exchange?
Yes, if it's the same client, we could certainly do that. Then we'd have to transfer the property out by deed rather than assigning the LLC. So it is possible. In most cases, because of the deed and issues like that, we usually will transfer the LLC and then do a brand new LLC for the next transaction. But it is possible to use the same one.
On the exchange, on the build exchange, do you require funds control, or is there even a requirement for funds control?
There's no requirement for funds control, so it really depends on the sponsor, excuse me, and the client and what they want. The fund control certainly protects both the sponsor and the client to make sure that everything is being paid, liens are being released, et cetera. There's no, in some cases, there's all sorts of a history where there's been developers or whatever who've run off with money. You've heard all these stories. So fund control protects all the parties. So it's a great way to go just to protect yourself, but there's no requirement to do so.
So what happens if I'm doing a reverse exchange, or a build exchange, and we get hit with delays, and I don't, I finish in 9 months instead of the 180 days?
Good question. If it's going to go for more than 180 days, then what we'll do is on the 180th day, we'll wrap up the improvement exchange. We'll transfer that LLC to the client so they become the owner. And only the improvements that have both been paid for and completed will qualify as part of their reinvestment. So that might mean that they've only gotten 60, 70, 80% of their improvements completed. So only those completed would count toward their reinvestment values. That might mean that they're exchanging short, so they might have some tax consequences. In a lot of cases, clients are trading up in values. So if that's the case, it might still be okay. It'll just depend on the numbers.
So what happens on that 20%? Well, that's what it's called boot?
Right? It's called boot. Yep. Funny name for that, isn't it? So yeah, it's boot. If the 20% that's not completed means that they've traded down in value, then it's taxable boot. It doesn't hurt the rest of the exchange, but they will pay tax on the portion that was not reinvested.
Now, I can't just buy stuff and have it sit in the garage, right? You're saying it has to be installed and completed, right?
Yes. A perfect example would be a client that says, okay, could you cut a check for $100,000 to pay the lumberyard? And the lumberyard dumps the lumber on the property. At that point, it still doesn't count because it's not real estate. It's just personal property, meaning non-real estate. It's just sitting on the dirt. But once you put it together, it becomes a frame, and you attach it to the foundation. Now it's part of the real estate. It would count.
Okay, so one of the things too is that complicates things is when there's a mortgage or leverage on the relinquished property. Now, can you talk about what has to happen on the other side of that?
Sure. So as an example, let's say you're selling property today and you've got $1 million sale price, you've got $400,000 of equity, you've got $600,000 of debt or bank financing. If you sell that, the requirement, as we talked about before, is after closing costs, you're going to have a net sale price of about $950-ish or so. Yeah. So that's what you have to reinvest. So you're typically going to go over, and if it's a straight across the board exchange, you're not exchanging up in value. You're probably going to buy something for about $1 million. In that case, the $400,000 of equity moves over. So you reinvest your equity on the new property, and the difference will be new debt of $600,000. So most people get another loan for the $600,000. You could replace that loan with cash. So some people say, I just don't want any more mortgage, and I'm going to put $600,000 out of my pocket into closing. And that certainly qualifies because you've still reinvested the full $1 million, and you've replaced the debt with cash out of your pocket. So that would count too.
And then you said that clearly the full amount, because you can't just say, well, I'm just going to buy a house with the equity. You're still going to have to pay taxes on the side that paid off the mortgage, right?
Absolutely. So in that example, if they bought a house for $400,000, they put the $400,000 of equity there. They've actually traded down by $600,000. That's taxable, and they don't prorate your cost basis. So that $600,000 would be 100% taxable. In that example, it probably would trigger the entire amount of taxable gain unless they've got a really low cost basis.
Wow. So how often do these 1031s get disqualified, and what triggers audits?
Good question. Most of the audit, usually when there's an audit, we get a notification because they go, I need documents. I can't find my documents. And so we don't see very many audits. Contrary to what people say out there, the audit ratio is fairly low for these things. Nationwide, all tax returns, the last statistic I saw is total audits were like 0.6 or 0.7% of all tax returns. So audits are very low anyways. 1031s, I would guess, are even lower, unless you're in states like California. That California targets 1031 exchanges, so it's probably higher in California. But it's a very low audit risk there. Most of the ones I've been involved with, too, weren't necessarily triggered because of the 1031 exchange. Maybe they had a 1099 and they didn't report it and it didn't match up on the IRS's computer system or something like that, so it gets kicked out for an audit. They audit the entire return. California does tend to pull returns for an audit because of the 1031 exchange, but usually it's larger transactions. They never tell you what the audit threshold is. I think it's somewhere around 5 million or above, because anything over 5 million seems to have a much higher audit risk than if it's under 5 million. Most transactions are under 5 million. So
that's the audit side of that. But how often do they get disqualified, and what do you see the most? What triggers those disqualifications more than anything?
I'm just kind of noodling here. Most of the ones I've been involved with in terms of audit, they're not disallowed. They'll find things like, I guess a perfect example would be on your closing statement. There's really 3 buckets. There's your routine selling expenses, which we talked about before, your broker's commission, title escrow, documentary transfer tax. Those are permissible. There's 2 other buckets. One is any lender-related items, so interest expense, demand statement fees, things like that. And your 3rd bucket would be operating expenses, so prorated rents, prorated HOA fees, prorated property taxes. The 2nd and 3rd bucket are not permissible. Most people pay those through closing anyways, and it doesn't hurt the 1031, but it does mean those items that are paid you're using exchange proceeds to pay for operating expenses instead of buying replacement property. So that triggers a tax consequence. Not a huge one, but it triggers a tax consequence. Most people don't know that, and a lot of tax advisors don't know that. So they report it as 100% tax deferred. They get audited, and all those little things get added back and triggers an issue. But then you get some people who don't identify, or if they do identify, it's after the 45-day deadline. Occasionally, you'll get somebody who closes on the purchase on the 181st day. So those are certainly disallowed. They'll find something like that qualified use is an issue. Maybe they moved into the property day 1. You can't do it. That's personal use. It doesn't happen very often, but some people try to play the game and it doesn't work. So usually those are the type of things we see.
Can let's say if I hold properties in my self-directed IRA, can I exchange those?
Great question. The self-directed IRA, it's either a traditional IRA or Roth IRA in most cases. They're either tax deferred or tax free already. So if you own real estate in that, you could certainly do that. We're an IRA custodian as well, so you can certainly do that. That's our sweet spot. So if you're selling real estate, it typically is not going to need a 1031 exchange. But in some cases, if you are considered to be a non-passive investor, because investments in the IRA are supposed to be passive. If you've invested in something that's an operating business, it might trigger unrelated business taxable income, or UBTI. Or if you've leveraged the real estate, it could be unrelated debt finance income, or UDFI. No, so that means when you sell the real estate, you trigger a taxable event, and the IRA actually may have to file a tax return, a 990T. But if you do a 1031 exchange at that point inside the IRA, then you don't recognize any gain, and therefore you don't have to worry about UBTI or UDFI. You don't have to file the 990T. So if you're going to, anytime you invest in real estate or any kind of an operating business, talk to your tax advisor. Find out whether it's going to trigger unrelated business taxable income or UDFI. And if it is, then talk to them about doing a 1031 before you actually sell.
And if they don't know, get another CPA.
Exactly. Yep. And what I said, they probably just glazed over because that's complicated stuff.
Yeah. Now, what does it mean when it's a step up in cost basis?
Good questions. So kind of a simple answer would be, let's say you bought real estate years ago for $100,000. Today it's worth $1 million and you pass on. You're going to leave that property to, kids or grandkids or friends or, whatever it might be. The fact that the value of that $1 million property is included in your estate for estate tax computation means that they can't double tax you. So it cannot be counted as part of your capital gain computation. So when you pass, the value is included in your estate. Whoever inherits the property gets a step up, which means the cost basis in the property is increased from that $100,000 that you bought it for up to the fair market value at the date of death. So your kids or grandkids or whomever, their cost basis gets stepped up to $1 million. They could sell it the next day literally for $1 million and pay zero taxes.
Wow. That's wow. That's interesting. What's the biggest mistake you've seen in your 40 years of doing 1031 exchanges? What's the biggest mistake you've seen?
Biggest mistake, number one, not paying attention to the requirements. And I know it's tough because you get all sorts of documents, reams and reams of paper when you're doing real estate, and nobody reads it. And that's part of the problem. So we've talked about trading down in value, not reinvesting things, identification, and all of those things. And it's amazing how many times people either don't identify or they think they can identify anything and then acquire something else. All sorts of just kind of crazy ideas. And then they're really upset when they find out their exchange is disallowed because they didn't follow the rules. The rules are documented everywhere. I mean, they're in marketing brochures, they're on websites, they're on all the legal documents. So read what's out there, read what's provided to you so you know what you're expected to do. And then it's a piece of cake, really. But it's just, people are busy. They just don't read anything. They sign it and that's it. And then all of a sudden they get surprised. So the biggest mistake is not paying attention to the details, not reading, not doing your homework.
We had an investor that, we do it at the boot camp and then it's available on video so they can go back to it. And we always tell them, if you're going to do a 1031, we're going to need some time to set some things up. Give us at least 2 weeks prior to your closing date. We explain that. And inevitably I got one of our investors. Now we've taken 175 investors to Florida. And Joey, hey, I just sold my property. We closed yesterday, man. I'm ready to exchange. And I was like, we've been talking about this for the last 6 months leading up to it, that I said, hey, before you sell, make sure we set everything else up. And he's like, that's why he just had to pay taxes on it. So that was
yeah. And then unfortunately, there's no way to go back and unring the bell, so to speak.
Yeah, that was hurt. Now I asked you what's the biggest mistake, but what's the most interesting exchange you've ever been a part of?
Oh, this goes back, well, a couple of them that come to mind. This goes back before they changed the rules to where it only applies to real estate. So probably the most interesting was an exchange of a 747. And the attorneys said, we don't want to deal with sales and use tax issues. So we want to do it in international airspace. So we all got on the plane and it hasn't gone green yet. So it's still built. It hasn't been built out. None of the seats are in there, except they put in just enough seats for the closing gene. And we flew out into international airspace, did the deal, did the wire transfer and everything, and then flew back and then, and they wouldn't let me fly the plane.
Oh man. You should have held them hostage.
Yeah, the oddest exchange we've ever done was an exchange of meteorites, and we got the phone call. We thought the guy who got the phone call said, "I think this is a crank phone call, but he's asking really good questions." So I took the questions, took the call, and sure enough, he had this meteorite that he'd owned for like 10 years. He basically found it years ago and put it in a museum and reported it on his tax return as an asset held for investment, which is shocking. And out of the blue, he got an offer to buy it for $1 million. So he sold it and said, what what can I exchange it for? And it's like, well, that's a good question. And
We're about to set some precedent right here.
yeah. And I said, well, first of all, I can tell you that the IRS has never ruled on an exchange of meteorites. But the question is, what's like kind is obviously another meteorite. I said, I don't know who would do that. And he goes, well, I did.
some other nerd.
Yeah, so I was about it. But I said, do minerals qualify or certain kinds of gems or, I don't know. It's just hard to say. In his case, he ended up exchanging for I guess you'd call it a portfolio of other meteorites. So it was interesting. I learned a lot on that one.
That's interesting. Well, Bill, you were wrapping it up here. Can you just tell folks how they can get a hold of you if they're interested in, other than calling us, how can they reach out directly to you?
Sure. Certainly calling you guys. We can chat, do a conference call together. If they want to reach out direct, website is a good way. We got a lot of the technical information on the website. So that's exeterco.com. So that's exeterco.com. And then, or if you want to call direct, I'm out at the San Diego headquarters office. So our number there is 619-239-3091. So 619-239-3091.
Well, Bill, I really appreciate you jumping on pretty short notice. I know we've been meeting ever since we started the boot camp, when it's relevant. We don't always have an exchange going, but I appreciate your time and you actually doing a refresh for our audience, because we get brand new investors, coming along all the time. So thank you.
Most welcome. My pleasure. Anytime.
For more information on hard money loans, trust deed investing, and upcoming events with the Norris Group, check out thenorrisgroup.com. For more information on passive investing through the DBL Capital Real Estate Investment Fund, please visit dblcapital.com.
The Norris Group originates and services loans in California and Florida under the California DRE license 01219911, Florida Mortgage Lender license 1577, and NMLS license 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the hard money tab.